Thank you, Ms. Chair. Good afternoon, ladies and gentlemen. I hope you're all excited to be back here having fueled your bodies with some yumsha stuff at the restaurant. Are we all excited to be back here? Great. If I may just zip on right away into our program and introduce our panelists for this afternoon. We've got Mandy Ramsden. She comes from an academic background before venturing into the corporate advisory and accounting profession. She is a director at Questco in South Africa. And our second panelist, our second panelist to my left is Mr. Ludwetsi Dumelo. He is the executive director of Affinitas. Ludwetsi comes from a capital markets background, and he's been involved quite extensively in the resources market here in Botswana. And then we've got Mr. Mashale Pumatpi, our third panelist. He comes from an engineering background, mining background, and he is the managing director of Shumba Energy, an entity which is listed here on the Botswana Stock Exchange as well as the Mauritian Stock Exchange. Sitting next to him is Mr. Anthony Siwawa. Mr. Siwawa is one of the pioneers of the private equity industry here in Botswana. I know he's also got an IT background, but he's really been involved in setting up the landscape for the private equity market in Botswana. And then to the far end, we've got Mr. Mark Turner. He is a veteran in the stock market. He's been very instrumental at setting up stock exchanges in the sub-Sahara region from the Malawian Stock Exchange. He's been involved from an advisory role with our very own stock exchange, the Botswana Stock Exchange, as well as, is it the Swaziland, Mark? Swaziland? The Swaziland Stock Exchange. He's a former group head of Imara Holdings Limited, an entity which is listed here on the venture capital market in Botswana. But currently he heads the Imara Capital Zimbabwe. Please welcome them, ladies and gentlemen. I'm really very excited before I go into the panel discussion just to echo one thing from this morning's session, which the CEO of the BSC talked to in the morning. He mentioned in the morning that they are looking at or in the process of applying for the BSC to be a member of the World Federation of Exchanges. And when I heard that, for me being an analyst, I was already digesting in my mind as to how very good that would be for our market here in Botswana, in that the stock exchange itself would actually totally re-rate if the BSC becomes a member of the World Federation of Stock Exchanges. Because under it, we have the Sustainable Stock Exchange Initiatives, which literally says that once our entities are regulated from that point of view, most companies here will be sought out by global investor in your social responsibility indices or your sustainable indices. So we are just about to re-rate as a country. One thing that I also took home in the morning was from one of our co-chair, Ma Moremo, when she said that as industry here in Botswana, we need to move away from being prudent to being bold. And that's actually a bold step that the BSC will be taking. A round of applause for them, please, in that regard. And, I will now go into our panel discussion. On our agenda, on the table for you on our panel discussion is, we're just going to talk to the journey that some of the startup companies or venture capital companies went through when they listed. And then we'll talk to you about, debt and capital markets. Before we zoom into the different equity financing options that we do have here on the Botswana stock market, and finally end up our dialogue with private equity and private equity funds, how they can be used to leapfrog certain companies here in Botswana to the capital markets. If I may just start with Mr. Ludwig Tumelo from Affinitas. If you may just give us a 2-minute introduction about a very short one about your company and your journey that you went through, your listing through the BSC, just prior to listing, during the listings process, and a little bit after. Thank you.
Thank you, Rao, and good afternoon, ladies and gentlemen. Our company is Affinitas Limited, which listed on the Botswana Stock Exchange in July 2015. Our journey through the listing process really started probably, let's say, within a year prior to the listing, where we went on the process of a capital raising. We had initially conceived a strategy that as a company we believe there is an opportunity in Africa which Botswana companies or Botswana investors do not have exposure to. So we put together the entity Affinitas Limited with a view to raising capital from the local market to invest in Africa. Prior to the capital raising, we applied for accreditation to the IFSC, and then we went through the process of capital raising through a private placement, and then subsequently we did an IPO. I think maybe as Rao has pointed out, coming from a stockbroking background, myself and the managing director had a fairly good idea of what to anticipate. So our listing was a fairly short process, and it was quite easy. We had good support from the BSE, and that's why we were able to list in such a short space of time. So we had a very short history, but that is, we've achieved our target, and now we're rolling out our Africa investment strategy.
Okay, thank you for that. Thank you for that, Ludwig. If I could direct the same question to you, Mr. Pumapi, could you talk to us about your journey on your listings process? And if I may say that Shumba Energy is listed both here in Botswana as well as in the Mauritian Stock Exchange.
Thank you. Good afternoon, ladies and gentlemen. Thank you for not falling asleep after lunch. Our objective as Shumba Energy has always been to develop coal projects, and we've subsequently added to that to develop coal-based energy projects and other energy-based projects. So the decision to list was made primarily to firstly allow the normal man on the streets the ability to take part in our story, but it's also a good way of allowing shareholders to see some return from their investment prior to us going into formal production. The process in both jurisdictions was fairly painful, but very similar. I think, fortunately, what I realized with the Botswana process, and actually being listed in Botswana, that it's a lot more economic than when we listed in Mauritius. So that is primarily to do with the cost of the advisors, and also to do, I think, with the ability for the process to move along fairly quickly. So I was quite happy with the way the listing went in Botswana, and we were quite happy to see a lot of retail participation in addition to the institutions.
Okay, thank you for that. And the same question to you, Mark Turner. I stand to be corrected, but I believe that you cleared all the thorns. You were the first venture capital company, Imara Holdings, to list on the BSE. What are some of the hurdles that you incurred on the way? Coming from your advisory background, it may have been a lot easier for you to be the person clearing the way for others to follow. Just a bit on your journey, please.
Thank you very much. Our journey to listing was fairly long. We started here in early 2003 as a tiny little Zimbabwe company that had come across the border. We realized that in the first thing, we needed to get credibility, and we also needed to have critical mass for the aspirations that we had to go throughout Africa. In that plan, from the word go, was we knew we had to be listed. And so from when we opened the doors in the 1st of January 2003, we had a plan which culminated with the listing. What we first of all did is we raised funds from friends, family, and business colleagues, which just gave us enough capacity. We then were able to do our first acquisition utilizing our shares with the promise that we would list. We then went out again on another small capital raising, and in that raising, one US fund decided to invest in us once again with the proviso that we listed. This was now sort of early 2004. We then worked from there towards the listing. When I say work towards the listing, as you heard from the discussion before lunch, making sure the numbers were correct, making sure the balance sheet was right, making sure the corporate governance was all in place. We realized in early 2006 that we were still about 8 months away from being able to list. And so what we did, we managed to persuade a number of the stockbrokers to trade our shares OTC. Now, in those days, there wasn't a formalized OTC, but we were able to soon make a market. We then listed in October 2006 by way of an introduction. Just as a matter of interest, we probably traded more shares in the 6 months that we traded OTC than we did in probably the first 2 years we were listed. So that's the job the brokers actually did for us. Maybe just also to finish off, the one thing I've learned in Africa is that if you are listed, for some reason, you are given an air of respectability and an air of superiority and an air of size. We were able to go all over Africa as a tiny little company. And the one thing I learned is the minute you walked into an office and the guy would say, "Who are you?" And I'd say, "Well, I'm listed on Botswana." You were in the door, and it was fantastic. And I really think that for you who are thinking about listing, that is one of the things that you need to bear in mind. Then I think just to finish off, just to give you an idea of the wealth that you can create through a listing if you do it properly. When we opened the door, we valued ourselves at $700,000. At the height of our market cap in 2008, we actually got to $112 million. So if you do it right, that's what you can do. Thank you.
There's inspiration there, ladies and gentlemen. Inspiration for those of you that are looking for making the journey to the BSE. With us here, we've got Mr. Anthony Siwawa, who is in the venture capital industry, as well as Mayor Mandy Ramsden, an advisor. Mandy, if I may hop up to you, for some of your clients that were looking at undertaking the journey to listing, what have you seen time and over again that you needed to pinpoint and say, could you fix that? Could you fix that?
I think the biggest issue the biggest issue for companies that are moving to listing, I mean, they're generally considering listing in an environment where their numbers are right. So they're profitable, they've got good track records. A lot of the work I've done has been in the property sector, so that doesn't necessarily apply, but a lot of the smaller companies that are looking to list, their numbers are right. I think the thing that kind of gets them at the last minute, and it's always unfortunately left to the last minute, is the constitution of their board. nowadays, if you're going to be listed, you need to comply with King codes, and very often it's a colour by numbers kind of exercise, and it's also numbers by colour as well, unfortunately, in South Africa. So there's this last minute rush to start appointing non-execs, and the non-exec plays, an independent non-exec plays an incredibly important and actually a very scary role. I've been an independent non-exec. And there's an awful lot of power that you're putting into the hands of this majority of people on your board. And therefore, I think, if you're going to work with these people and they need to trust you, I would say start trying to become a listed company. Start acting like a listed company, even though you're not listed. You've got people to help you with the prospectus. You've got your advisors to price you. You've got, in our market, the sponsor. You have a sponsoring broker is generally your advisor as well. They're playing this coordination role, but at the end of the day, you have to stand on your own 2 feet and operate with this governance structure. So to me, don't leave that to the last minute, because I've seen companies scramble for directors when you're still trying to get your prospectus into the JSE with that the last Schedule 13. And make sure that they're people who understand your business if possible, who lend gravitas to your brand, and who you trust.
Okay, thank you. Re Siwawa, the venture capital on the Botswana Stock Exchange. In your opinion, where would you like to see the landscape? How would you like the landscape to be, or what direction would you like to see it going?
That's a very good question. I think maybe if I just take a step back and look first at the landscape in Botswana.
Yes.
Around the early stage or funding of early stage and growth of businesses. I think that's the starting point.
On the startup.
And just to give context to that, I did a little bit of research, and in 2014, Botswana had about 14,000 companies registered, 14,800 or so. And it is important to note that out of those 14,800 companies that were registered by the Registrar of Companies, only 22 were listed. And what that says is that there was, let's say, 98% of companies in Botswana did not necessarily have access to a formalized and institutionalized route to capital, which is fundamental if we are talking about how we then transition, whether it's 5% of those companies, to a venture capital board listing or a main board listing. So I think that there's a lot of work that needs to be done, both from a regulatory perspective, in terms of creating appropriate channels, whether it be pools of capital to assist that transition or facilitate that transition, or a means to facilitate an easier access. I remember Tapelo talking about it earlier on, about how they would like to make the venture capital board a little bit more accessible, how they're looking at the over-the-counter board to facilitate that. So that's the end point. But I think there's still a lot of work to be done on the regulatory side. And we can take a lot of time discussing that and the institutional framework to support that. But I think I'll stop here and just say I think there's a lot of work that needs to be done in that space.
Okay. And what's your take on that, Mark?
I think I agree, but regulations, I think, should always sort of come after the cart, rather than before. I think what happens in the smaller markets is that, too often, we look to New York and we think we need, to recreate New York here. The rules work for New York because they're in New York. More often than not, they don't work in Gaborone or Lusaka. They just don't work. So you need to have a regulatory regime which, yes, understands the rules. The rules are there, but they also need to be adapting those rules in order to facilitate the growth, really, of the domestic market. And, you know, certainly in the early years of an exchange, or the development time of a new sector of the exchange, you know, your regulator needs to be understanding and, you know, see, really, in order to see what will work for the market, for the potential entity, in order for that market to actually grow.
Okay, there we go. Just about to wrap up the session. 14,000 companies registered in Botswana and only 22 listed. If I may just move along and direct the same question to Mr. Pumapi and Mr. Tumelo. If you could just walk the delegates through how your post-listing journey the first year was. In just a minute, please.
Okay, I think from the financing perspective, what's important is at the beginning, I agree with the other speakers, is to get the governance and corporate structures in place that sort of impersonate a listed company. So you must have your accounts audited at least on an annual basis. You must have, you know, different levels of corporate governance, whether it's remuneration committees and that kind of thing. I think that's important prior to the listing to make sure that it has two effects. The first effect is that a lot of times it may expose a number of weaknesses in your business, so you may not realize where funds are being spent unnecessarily, or you may not realize that some people are somehow getting funds out of your company. So that good governance and good structures helps to streamline the business and really simplifies the business to a state where you know, okay, is what we're doing working? Do we need to change anything? But secondly, what it does for your existing investors, we had a lot of, similar to Imara, friends and family and high net worth individuals prior to the listing. It gives them comfort that actually, you know, you're doing things the right way, and they don't worry so much that you're operating a black box operation that is not, no one can look into. Post-listing, normally your investor base changes to more of an institutional based shareholder base. So you get the bigger guys, the pension funds, etc., who require you to be listed to invest coming in. But also, one thing that's very important is that you now need to make sure that you comply with all the regulatory requirements. So whatever you're doing before, surprisingly, always doubles up, and especially if you're reporting in two jurisdictions such as us, it seems that you know, both jurisdictions have got the rules. They may be slightly different, so you need to comply with both sides, which can be quite costly from a time perspective. But it's good, again, because you're now checked on two sides, so you really have to be squeaky clean in what you do.
Okay, Mr. Tumelo.
Yeah, I would concur with what Mashali is saying. Once you get to the post-listing phase, your internal operations would change, because now you have more regulation to deal with. The stock exchange has got requirements that you have to meet, in addition to what you were already meeting before in terms of the Companies Act locally. But I think from what I picked up post-listing, which is something that I would like to see developing going forward, is that the VC market needs to be developed, or understanding of VC stocks need to be developed locally.
Sorry, what market?
The venture capital market,
Okay,
on the
okay.
Botswana Stock Exchange. And this is primarily because from what I've observed is our investors are more familiar with the stocks that are on the main board. So where you've got your historic financials where you can value the company, look at the past 5-year track record, do your different valuation models, put in your profit forecast. But when it comes to VC, it's a slightly different kettle of fish because a lot of the time, those companies are promoting a concept and they don't have historic financials to back them. So it would be great if maybe throw the challenge to Thapelo and his team that, we need to focus on growing that understanding of venture capital. I think, for the listed entities, it would be great because it means more trading in their stock. It means they get a true valuation of their companies. But from a country perspective, it basically means we are able to attract more companies because they can raise more money on the stock market and create more Botswana companies through that route.
Okay, thank you. Anthony, I'll direct a similar question to you, but very similar, not exactly the same. In your portfolio companies, a lot of the times you meet companies at different business cycles. We're talking about startup now, we're talking about venture capital. The uniqueness about the Botswana business landscape is that we've got a lot of startup companies that die before they even get a lifeblood. In your opinion, at what stage should a company incur debt, or they should go the equity route? Or does it actually really matter depending on which industry or sector a particular company is in?
The easiest answer to that is it depends.
Okay.
And the reason for that is, as you pointed out, you've got different companies in different sectors with different cash flow cycles. And at startup stage, and believe you me, I've had my fingers burnt a lot by startup businesses. And the old adage that 9 out of 10 startup companies fail, I don't actually agree with it. I think 10 out of 10 startup companies fail. And sometimes you are lucky that one does succeed. But the reason why I say it depends is that it's also a function of the market. If you look at the Botswana market, access to capital fundamentally is through accessing debt, whether it's debt from your uncle or debt from the banks, but it's fundamentally getting debt from somewhere in order to get your business. You might be lucky that you maybe there's a CEDA or a BDC that is able to provide some equity, but it's not often the case. And that was the point I was making earlier, that while we have a very good contractual savings environment in Botswana, we don't have a well-defined policy frame. Well, now it's defined because NARNALE PFR2, which kind of gives some guidance around allocation to alternative assets such as private equity and venture capital. So it means that there's some indicators about how much of that capital can be allocated to VC and to private equity. So there is now an option. And if that option is there, you will find that more and more venture capital or startup businesses will start to have access to equity, because equity really is the starting point for a business at startup. It's really the best solution because you really need a longer time between cash outflows of your business in order to develop and sustain the business.
And what's your take on that, Mark?
I think it's more or less the same, but usually you will find you already have equity in the business because the founder has started it. More often than not, a founder of a new business, he will go along and, as my colleague said, he'll borrow from his uncle until he reaches a stage where he can go to the bank. He then develops more of an ethos where whenever he needs cash, he'll go to the bank because it's easier. However, at the end of the day, that debt always has to be repaid, and it has a cost. That usually then is the time that business has arrived really at the right time to go looking for more equity. That then, for the entrepreneur or his partners or his family is a major step change for the rest of his life. And you find that probably 99 and a half out of 100 entities can't make that step change. It's very, very difficult. However, to move really to the next level, if that's what you want to do, you need to make that step change, and you need to bring in some equity capital.
Okay, anyone from the panel discussion with a dissenting view from the other?
I'd just like to add to that and say, I think, especially for companies on the venture capital exchange, unless you've got revenues and you're making decent profits, really, you don't want to have debt. I mean, there are other solutions, apart from just equity. You can look at the quasi-equity solutions such as convertible loan notes, but you always have to be careful to make sure that the terms are not a hindrance to the company. So ideally, as they say, equity is the number one solution, but sometimes people want more security with the funding that's coming in, and that's when you have to be careful. But just plain vanilla debt can be extremely difficult for a company and can actually stifle growth, especially in the early stages.
Okay, Re Tumelo, does it matter, debt or equity?
Well, look, as just to add on to what Marshall is saying, I think if you're at the VC stage, I would probably say equity is your best friend at this stage. You don't have any revenue inflows, and it would be difficult to convince anybody to lend you money on the condition that you can repay it when you're not able to show any cash flow statements that would show how you'd repay that debt. So until such a time that your company is at a point where you're able to say, this is our cash flow forecast for the next 5 years, I would say for a VC company, venture capital company, just stick with equity for now.
Okay. Mayor Ramsden, I see that you've done quite a lot of rights issues. You've done a lot of private placements for some of your clients. What motivates you to actually recommend that over debt? In other words, what would be the advantages of equity over debt?
And I think, as I said earlier, the question of whether it's debt or equity is answered by, should I have it? It depends. It depends where you are in your company life cycle, and obviously those clients are all listed. I think we're in an economic environment where debt is becoming more expensive, where investors are wary of companies being overgeared, or being very exposed, especially in an economic downturn where perhaps profitability may decline and the ability to service that debt becomes more and more difficult. I think the rights issues that we've been doing, that you see that there's massive capital expansion. So there's something to actually apply the equity to. There's no specific answer as to whether you should have more debt or less debt, more equity. It's really about what you're going to do with the money. What is the environment you're in? What are the specifics to your industry, and what are the specifics to your company? And what is the cost of that equity? Are the equity capital markets relatively cheap? Do they like my company?
Okay. I will be crossing over to the floor in the next 10 minutes or so, but I just want to throw one question at our delegates. Is there anybody on the floor that's got a different view from debt versus equity? Our panelists over here seem to love equity quite a bit. Anybody here who can rescue the debt situation and say debt has helped my company?
Surely the bankers must have a view on this.
I want a dissenting view because we want to balance the dialogue in here. What may necessarily be suited for one industry or sector is not for another one. So anybody with a different view in the room? Or we all love the BSc? Super. That's all. Okay. If we, sure, go through.
I must just state this point, that as private equity investors, we also do like debt. We see debt, we don't see debt as a problem because it complements equity and obviously contributes to what I would believe well, the leverage that debt provides is good for valuations in the long term. So I'm not saying that as an investor, that debt is anathema to an investment. As a private equity investor, my view is that I would like to get as much debt as possible as long as it can be supported by the cash flows in a business. That is always important.
Okay.
And I think CPD wanted to say that as well. Thank you.
You've covered.
Is that what you wanted to say? or you-
It did,
okay,
but I think maybe I'm jumping the gun here to questions. I think there's a slight differential between sort of listed equity. So I think my question was actually going to be to Mr. Dumelo, to say that he chose the route of doing a VC listing versus tapping into the private equity markets. So there's a huge differential between the two, and I'd be interested to understand from him why he didn't choose the latter, being the private equity route. So I think to me there's a huge differential between the two versus, and I'd like to understand that point. But I think Mandy sort of illustrated quite clearly why as bankers we'd prefer the equity route until we saw cash flows. Many instances, what Mr. Dumelo has put forward, it's blue sky. We want to actually see that, the cash flows of the business.
Sure. If we may just move on to our third agenda item, being the different equity financing options on the Botswana Stock Exchange. I don't know if you want to speak to that, Mr. Dumelo. From a strategic alignment point of view, she's just pointed a finger at you, why VC and not private equity. There's obviously a strategic alignment when you go venture capital. There's alternatives of rights issues in the future. There's private placements, there's scrip issues, etc.
From our point of view, going the listed equity route was more attractive for the reason that we were coming up with a blue sky opportunity, and we realized that the local private equity market was, should I say, small for what we wanted to achieve going forward. But we also realized that the exchange itself, firstly, gave us greater access to capital. And also, it meant that going forward, we would be in a position to raise more and more funding from being a listed entity. That's why we went through the listed equity route.
Okay, there's a lot of employee incentive schemes, which is another route that applies for any company really, whether private equity or whatever. But I have never actually in the Botswana market, so far as my memory serves me, recall a clawback offer. Why are they not common here in our market? Mark?
I think it's more to do with the evolution of the market. And I would imagine that you will actually see one sooner rather than later. It's all part of a process. Also, you find here that you have an underwriter to a level. There's a statement that they're going to raise a certain amount. And in essence, that's what they do. It's what the market understands. And I think you will find pullbacks coming. You will find green shoots coming in the fullness of time.
I will start this one here. If I may just, because we're running out of time, we've got just 5 minutes before we hand over to you delegates. So please, in your minds, map any questions that you may have for the panelists. But moving along to the private equity or the private fund sector here in Botswana, I always maintain, as Mr. Siwawa has mentioned, that there's 14,000 companies that were registered in the Botswana market in 2014, and only 22 listed. Now, when you look at the financial value chain or our ecosystem here in Botswana, I believe that the missing link is the private equity, which is very critical to ensure that a lot of entities can leapfrog into the capital markets. What is the landscape in Botswana? Mandy, and then I think we'll just all take it and give it a shot. Do you know what the landscape of the private equity market in Botswana?
I don't fully understand, I don't know the statistics in Botswana. What I can say in South Africa is that private equity plays a very, very important role in the development of companies to the point where listing is appropriate. You've seen AltX develop over the last, I don't know how long AltX has been around. It's been around a long time, and I've sat on the committee for a very long time. And I think there's a misnomer that AltX is there for venture capital. It's not. It's actually there for small companies, for small established companies, and provides actually a nice exit, provides a platform for smaller companies looking to raise capital and exits for private equity firms. I think the one form of capital that hasn't been mentioned today at all, I haven't heard it at all, which is becoming pretty big in South Africa. We're seeing the emergence of some pretty large mezzanine funds looking to put money into a gap between private equity and listed vehicles. And the reason for that is that entrepreneurs, certainly entrepreneurs in the earlier stages of their existence, actually have to give up quite a lot from a funding perspective, because there's a fair degree of risk that is assumed by a VC fund or a private equity fund, and they want a return on that risk. And that return is taken through an equity stake, and that equity stake is bigger than it would be potentially for a listed fund raising the same amount of capital. Where the mezzanine guys play is that they get essentially an equity return, but they don't necessarily have an equity stake. So their rights and obligations are embodied in a contract, and you can be extremely creative with the type of mezzanine finance that you create, because there are no listed rules. There's no, you don't have a private equity player dictating as much as you might have. So, mezzanine is a very, very large sector now, and I think that is certainly attractive for smaller players to start to think about, to facilitate their growth.
Okay. Lutletsi, you've given it a shot. You've answered it. If I may just hop over to Mr. Mashale. What's your take on it? Of the landscape. I know when you look at Shumba, you've dealt with quite a bit of private equity shareholders. What do you think the landscape is here?
I think there is private equity for revenue-generating companies, companies that I think would qualify for the main board. But for VC, there's very little. I think there's zero. I mean, when we were starting, and the first couple of years, we actually got funding out of London, Mauritius, Canada, but nothing from a domestic front. So there's a big gap for companies that are starting up and need that growth in order to qualify for listing. And I think what's been raised about mezzanine funding could be quite key. I think that it's about the mentality here. In a previous life, I've worked for one of our funds was a private equity fund, and the approach is that it's more of a portfolio approach. So you understand that there is a significant portion of your portfolio that will not make it, but you also realize that the few that do, the returns will be so good that they'll make up for the ones that don't make it. So it's about, selecting quality management, looking at good opportunities. So you do all your homework, and then, you take a portfolio approach. But unfortunately, in Botswana, what we found is the private equity is more comfortable with, the likes of, I don't know, large insurance companies that are already generating cash flow and the like. So I think it's an area that really needs to be developed, and maybe the over-the-counter market will assist with that, get some liquidity for those type of companies, but it is a serious problem.
Okay. Arasiwawa, you've heard Mr. Mashale. The same question to you, and with another leg. What is it that foreign investors or foreign private equity funds who have filled our shareholder registers on the venture capital board see here in Botswana that some of our bigger investors don't actually see?
I think, to start with, there is very little early stage funding in Botswana. If you go outside the development finance institutions, such as CEDA, BDC, and I'm not mentioning your name so that you're going to give me something after this, but it's the reality. There is not really much, except maybe for high net worth individuals and so forth, or the likes of the De Beers social responsibility financing. And so there is a big gap. In 2008, we had a quasi-VC fund that we managed. And at that time, when we did our research, there was about 3.5 billion in demand for early stage funding in Botswana. That was in 2008. So there is a gap, there is a demand, and I'm not surprised that Ramashale came across that kind of circumstance in Botswana. I think one of the reasons is that the industry, the equity funding industry, the private equity funding industry in Botswana is still at a very early stage of development. There is a lack of understanding about the risks associated with investing in early stage risk-based securities outside of the capital markets. And I mentioned earlier that we now have some policy framework that guides pension funds, for example, who are looking to allocate some of their pools of capital to this type of instrument. But it is just a policy framework. So even when there is some capital available, it is still not geared towards that space. And it will take time. But I'm glad to say that there are ways and means in which one expects to see some capital flows that will result in future younger Mashales not having the difficulty and the challenges that he's had. And the end result being that he's funded out of London, out of Canada, for a business that is exploiting resources in Botswana.
Okay. Moremeng earlier on this morning noted the fact that it's good to be prudent. You're talking about risk aversion. It's good to be prudent, but the country also needs to be very bold if we are to try and migrate the country from a middle-income country where we know that we've lost most of our developmental financing to an upper middle-income group. How can we actually catalyze the industry in Botswana, Mark, in your opinion? Yes, please.
Well, I think this, it's awareness. There's a greater weight now of capital that's looking for a home. It was always easier just to put it into a Bobsy or the bank and go for lunch. And I think that now, is beginning to change. And I think this latest, privatization and IPO will go a tremendously long way, towards doing that. There is a lot of capital that's available in Botswana, and it's always looking for a home. So, if you've got the right project, the right idea, you will find the capital.
Okay, if I may just close the session, unless one of the panelists has got, or maybe I should just go around and say your closing remarks in just 30 seconds each, something that you're really burning to say out.
I think the point I would make is that to a lot of our asset managers, that they need to also be bold. They need to take the lead in unconventional instruments that come to their table. And that's one way of leapfrogging the normal, traditional development process of the financial services sector. So for me, I mean, I've seen the transition in the asset management industry. Very young Botswana, very well educated, very smart, very forward-looking. But we also need to take off the shackles and be bold and innovative and take leadership of our industry.
Anybody with a critical point or your closing remarks?
I think really, my view is for us as a country to move forward, we need to look at our venture capital or our startup companies and see how we can fund them to grow. And the stock market is one way, which we've found to work very well for us. I think, that's the way we can grow the next Choppies. That's the way we can build the next big Botswana entities, if they can get easier access to funding. And also just what Anthony Siwawa is saying, we need to take off the shackles, not just the pension funds, but I think our investor mindset needs to be more adventurous and look at more riskier instruments.
I think I just want to echo the same point that Siwawa made. We've embarked on a number of capital raisings. Very often they're not capital raisings necessarily for a listed entity. They're often unlisted entities that we're looking to raise money for. And I find many of the private equity companies are quite risk averse. In theory they take greater risks, but they're not very bold. And if entrepreneurs are to get off the ground, and I disagree in a sense and clearly you've had a successful listing, so maybe I'm wrong, but I would discourage younger companies to go to the market for their equity capital requirements. But I would encourage the fund managers, whether they be institutional fund managers or private equity companies, to be a little bit bolder. I know we're in a difficult time. The world is in a difficult place, but that is the only way we're going to unlock the equity that's required to encourage entrepreneurs to grow their businesses.
Mr. Mashale, in just 30 seconds, please, and thereafter, Mr. Turner.
I think as a country, we're reaching a fairly critical point. Our reliance on one revenue source is a big problem. And we really have to make an effort to develop other industries. And, some will fail, but it just takes one or two to really pick up. And in the next 30 years, we'll have a totally different economic income structure. So I think that's very important, whether it's through the stock exchange or whether you choose to remain private a bit longer. It is important for us to really, as Botswana, think how are we going to stimulate more of these locally grown companies to create jobs and develop the economy.
Hi, everybody. My name is Malik Shehu, and I'm from Holland Mansell. My question is for Ms. Mandy Ramsden. I've been hearing about how equity is good, equity is good. But sometimes when you go seek capital, right, by equity, don't you become subject to the scrutiny of the market? Sometimes companies which list on the BSE or the JSE or anywhere, whenever the value of the stock price or the share price goes down, they become worthless. And sometimes, in a behavioral finance perspective, investors, they're not all that rational. Something may happen, negative news in the company, the stock price may go down. And sometimes that's not the true value. The true value may be higher, and it takes a while for the price to reach the value. So now my question is, the volatility and also the slow growth from the price now to the fundamental value, isn't that a risky part about equity, as opposed to, debt, where you're not under the subject or the scrutiny of the marketplace?
Well, you're always going to have a boss. One is called your shareholders, and the other one's called the bank.
Okay.
So, the two sources of capital are not necessarily in competition with one another, equity versus debt. The source of, at the end of the day, you're going to get to a point where you cannot gear anymore. So, in the example that I gave in Eastern Europe, where the spreads on property funds are, property investments versus the cost of debt are very large, and you can hedge out your debt exposure. Sure, you can gear and you can gear and you can gear until nobody's going to lend you money anymore. So you can't gear to infinity. You do need to have equity somewhere in your mix. It's just a question of how much. And it's a question of your, as the entrepreneur's, appetite for risk, especially when it's your equity that you're putting in. When it comes to the equity side of things, I guess I did focus largely on listed equity, or the equity capital markets, because that's what this is. This is a conference focusing on listing on the BSE. But there are a number of equity sources, and this is what we've been talking about today. And yes, if you don't like the, if you don't want to face the prospect of what goes up also possibly comes down, if you are not willing to, if the volatility of the market scares you, if you're not in it for the long term, then I agree. Then going to the equity capital markets, especially in these volatile times, is maybe not the right place for you. I think when you go to the stock exchange, you go with the expectation that you're going to be there for a long time, because if you think getting listed is hard, try and get unlisted.
Okay.
So, the decision to take money from the equity capital markets in that very public way and have your skirt right over the top of your head for the rest of your corporate existence, that decision can't be taken very lightly, but it is a long-term decision, and ultimately we see that history has shown that the returns in the listed environment over the very long term have been very good, and that although you have these volatile times, you do have times when the market is going down over the very long term, and that's what you should be in it for.
Thank you,
Over the
Mandy.
very long term, you probably do better as a listed company.
Thank
If
you.
you're at the right stage of your corporate existence.
My name is Dumi Mbaganyi. I'm from a company called MEMME CPA. My question is directed to Ms. Ramsden. I would like for you to just share with us, because I'm just looking, because I'm a consultant and I know a lot of our SMEs in terms of equity, it's usually your 3,000 shares. Usually that's the ordinary share capital that there would be, and maybe the accumulated reserves. I would like to know, is there another indicator besides the debt equity evaluation of a business that the stock markets use? That's the first one, which could be your dividend valuation, your earnings per share. I would also like to know other indicators that the stock markets look at, like target indicators. Your internal rate of return, what's the target? Earlier on you touched on return on assets. What's the target figure? Because as SMEs, we want to know what we are working towards. Besides, I know you've mentioned the 5 million turnover, which a lot of businesses have here. You've mentioned historical 3-year profits, which a lot of businesses have. So clearly, there is a catch somewhere. It's not easy for companies to get listed. Despite all that, we still have 22 out of 14,000 companies. So maybe this Tapelo could also answer. Thanks.
Okay, so that's a lot of questions, and it's a very, very complicated topic. If I'm an investor in the stock markets, I put my investor hat in, there are a number of things that are going to affect your valuation, and profitability is going to be one thing. And the degree to which you're operationally leveraged, the margins that you have. I mean, I'm putting on an analyst hat now. If you have got very large gross margins to cover your overheads, that makes you less risky. So if you've got very tight, some businesses, they have a very, very thin gross margin, and if there's a hiccup in turnover, that means that your overheads are going to struggle to be covered. Your price to earnings multiple. So if I'm an investor, I want to see compared to other stocks, and very often it's a choice. I've got money that I want to invest, and where's a stock cheaper than another stock? So it's a constant peer evaluation. Am I cheaper in terms of my price earnings multiple than other companies? There are just so many different metrics that that vary from industry to industry, from company to company. In terms of gearing, banks will look at it, and so will investors. How big is your safety margin to cover your interest bill? So how many times does your profit from operations or your cash flows from your operations, how many times will that cover your interest bill? So if times get really hard, can you still pay for your debt? And that goes back to the question of whether you're overgeared or you're undergeared. Okay. It's an incredibly complex scenario, and analysts this is what analysts do. They will actually look at each individual company and decide how they are going to evaluate or value that company.
Okay, thank you for that last.
It's a ham-fisted answer, but it's a vast topic.
Yeah, it was a multifaceted question coming
just add
from.
something onto that as well, because at the end there you mentioned that there's 14,000 companies and only 22 are listed on the exchange. Maybe to give you an idea, one of the things that I think could be contributing to that scenario, I'll just put on my stockbroking hat from a past life. One of the things I encountered is that when you talk to owners of businesses and you say to them, be a listed entity, one of the main deterrents is that they see that they are losing control of their company, or they are sharing control of their company to other investors now. The guy who's going to come in and buy 100 shares in your company, trust me, when he wants to meet you, and you have to pay attention to him. When the stock exchange now tells you that you have to print an annual report when you could have just sent an email to all the other guys, that change is what deters a lot of companies from coming to the market. And I think as our market develops, and as more and more of the family-owned businesses get to a point where maybe the initial promoters of the businesses are no longer able to run with them, then we will see an increase in more locally owned companies come into the stock market. But for now, there's that I'll call it psychological thing that they do not want to part with 100% control of their entities.
Okay, thank you, Lutwetsi. There it is, ladies and gentlemen. You've heard it from our expert panelists, whether it is debt or whether it is equity, or you use the private equity landscape to leapfrog your company into the capital market, either through debt or equity. The door to the BSC is open. Give them a round of applause, please.